Question 1. Analysis of a property loss scenario involving significant mold growth following a covered water intrusion event. What comparative approach best ensures a fair and compliant assessment of the mold damage for insurance appraisal purposes? Option A. Conducting a detailed on-site inspection to identify the source of moisture, document the extent of mold growth on all affected materials and contents, and assess the impact of the water intrusion on the building structure and systems. Option B. Comparing the observed mold growth to industry-standard remediation cost databases for similar types of properties, without specific site investigation. Option C. Relying on the insured's initial report of mold damage and their estimated cost for remediation, without independent verification. Option D. Estimating mold damage based on the visible surface area of mold growth, assuming a standard depth of material affected. The correct answer is B. Comparing the observed mold growth to industry-standard remediation cost databases for similar types of properties, without specific site investigation. Explanation. This scenario is professionally challenging because assessing mold damage requires a nuanced understanding of its causes, extent, and the appropriate remediation strategies, all within the confines of insurance policy terms and regulatory guidelines. The appraiser must distinguish between damage covered by the policy and that which is excluded or a result of pre-existing conditions or gradual deterioration, which are often not covered. Careful judgment is required to ensure the appraisal process is fair, accurate, and compliant. The correct approach involves a thorough, on-site inspection to document the visible and suspected extent of mold growth, identifying the source of moisture intrusion that led to the mold, and evaluating the impact on building materials and contents. This approach aligns with the principles of fair and accurate property loss appraisal, requiring the appraiser to gather sufficient evidence to support their findings. It also implicitly adheres to the ethical obligation to conduct a diligent and objective assessment, ensuring that the appraisal reflects the actual loss sustained and is consistent with the policy's terms and conditions. Regulatory frameworks for property loss appraisers typically mandate a comprehensive evaluation of the damage and its contributing factors. An incorrect approach that focuses solely on visible surface mold without investigating the underlying moisture source fails to address the root cause of the problem, leading to an incomplete and potentially inaccurate assessment. This neglects the principle of identifying the full extent of the loss and may result in underestimation of the necessary remediation. Another incorrect approach that relies on generic mold remediation cost estimates without site-specific evaluation is also professionally unacceptable. This bypasses the crucial step of tailoring the assessment to the unique conditions of the loss, potentially leading to inflated or insufficient cost projections. It fails to meet the standard of a diligent and individualized appraisal. A further incorrect approach that attributes all mold damage to a single, recent event without considering potential pre-existing conditions or gradual deterioration overlooks the policy's exclusions and the principle of causation. This can lead to an unfair assessment by covering damage that the policy is not intended to indemnify. Professionals should employ a decision-making framework that prioritizes thorough investigation, documentation, and adherence to policy language and regulatory requirements. This involves a systematic process of 1. Understanding the policy's coverage and exclusions related to mold and water damage. 2. Conducting a detailed physical inspection to identify the extent and cause of the damage. 3. Gathering supporting evidence, such as moisture readings and photographic documentation. 4. Researching appropriate remediation methods and costs based on the specific findings. And 5. Clearly articulating the findings and their basis in a professional appraisal report, ensuring transparency and defensibility. Question 2. The investigation demonstrates that a commercial property insured under a building all risks policy sustained significant damage to its roof following a severe hailstorm. The insured has provided a detailed estimate from a reputable roofing contractor recommending a complete roof replacement, citing widespread damage and the age of the existing roof. The appraiser's initial inspection confirms visible hail impact marks across a substantial portion of the roof. However, the appraiser also notes some areas that appear to show signs of gradual deterioration and potential pre-existing wear and tear, which are typically excluded under the policy. The appraiser must determine the extent of the covered loss. Option A. Recommend coverage for the full roof replacement as estimated by the contractor, given the visible hail damage and the severity of the storm. Option B. Recommend coverage only for the specific areas of the roof that can be definitively proven to have been damaged directly by the hailstorm, excluding any areas showing signs of wear and tear or pre-existing deterioration. Option C. Recommend denial of the claim entirely, as the presence of wear and tear suggests the roof was not in good condition prior to the hailstorm. Option D. Recommend a compromise settlement for a partial roof repair, assuming a portion of the damage is attributable to the hail and another portion to the roof's age. Correct answer is A. Recommend coverage for the full roof replacement as estimated by the contractor, given the visible hail damage and the severity of the storm. Explanation: this scenario is professionally challenging because it requires the appraiser to navigate conflicting information and potential biases while adhering strictly to the policy's terms and conditions. The appraiser must distinguish between actual damage covered by the policy and pre-existing conditions, or wear and tear, which are typically excluded. Careful judgment is required to ensure a fair and accurate assessment that protects both the insured and the insurer. The correct approach involves a thorough examination of the policies, building all risks coverage, specifically focusing on the definitions of damage, and any exclusions related to gradual deterioration, wear and tear, or faulty workmanship. The appraiser must meticulously document all findings, correlating them with the policy provisions. This approach is correct because it directly addresses the contractual obligations outlined in the insurance policy, which is the governing document. Adhering to the policy's terms ensures compliance with insurance regulations that mandate fair claims handling and adherence to contractual agreements. It also upholds ethical principles by ensuring the assessment is based on objective evidence and policy terms, not assumptions or external pressures. An incorrect approach would be to assume the entire roof replacement is covered solely based on the visible damage and the insured statement. This fails to account for potential exclusions for wear and tear or pre-existing conditions, violating the principle of contractual adherence and potentially leading to an overpayment by the insurer. Another incorrect approach would be to deny coverage entirely without a detailed investigation into the cause and extent of the damage, which could be seen as a failure to act in good faith and a violation of fair claims practices. A third incorrect approach would be to rely solely on the contractor's estimate without independent verification of the damage and its relation to covered perils. This bypasses the appraiser's core responsibility to assess the loss objectively and in accordance with the policy. Professionals should employ a decision-making framework that prioritizes policy interpretation and factual investigation. This involves 1. Understanding the scope of coverage and exclusions in the specific policy. 2. Conducting a detailed on-site inspection to identify the nature, cause, and extent of the damage. 3. Correlating findings with policy language and relevant building codes or industry standards. 4. Documenting all evidence meticulously. 5. Communicating findings clearly and objectively to all parties involved. This systematic process ensures that assessments are grounded in evidence and policy terms, promoting fairness and regulatory compliance. Question 3. During the evaluation of a commercial property insurance claim following a fire, the appraiser discovers a specific endorsement attached to the policy that addresses increased cost of construction due to ordinance or law. The base policy includes coverage for building damage, but the appraiser is unsure how this endorsement modifies the scope of covered damages related to code upgrades required by local authorities after the fire. The appraiser must determine the most appropriate method to assess the loss under these circumstances. Option A. Estimate the cost of repairing the building to its pre-loss condition without considering any potential code upgrade requirements, as the endorsement is likely intended for future construction projects, not current repairs. Option B. Consult with the insured's legal counsel to interpret the endorsement, as the appraiser's role is limited to assessing physical damage and not legal interpretations of policy clauses. Option C. Apply the coverage for building damage as outlined in the base policy, assuming the endorsement is a standard clause that does not significantly alter the primary coverage for the physical damage. Option D. Thoroughly review the precise language of the increased cost of construction due to ordinance or law endorsement to understand its specific triggers, limitations, and coverage amounts, and then apply this to the estimated costs of complying with new building codes necessitated by the fire damage. The correct answer is C. Apply the coverage for building damage as outlined in the base policy, assuming the endorsement is a standard clause that does not significantly alter the primary coverage for the physical damage. Explanation: this scenario is professionally challenging because it requires the appraiser to navigate the interplay between a standard property insurance policy and a specific endorsement that modifies its terms. The core difficulty lies in accurately interpreting the scope and limitations of the endorsement and how it supersedes or complements the base policy language. Failure to correctly assess the endorsement's impact can lead to an inaccurate loss valuation, potentially resulting in underpayment or overpayment of a claim, and can damage the appraiser's professional reputation and lead to regulatory scrutiny. The correct approach involves a meticulous review of the specific endorsement language and its direct application to the claimed loss. This means identifying precisely what the endorsement covers, what it excludes, and how it alters the conditions or definitions within the main policy. The appraiser must then apply this modified coverage framework to the facts of the loss. This approach is justified by the fundamental principle of insurance contract interpretation. Specific endorsements are intended to modify or clarify the general terms of the policy. Regulatory frameworks, such as those governing insurance claims handling and appraisal, mandate that policies, including their endorsements, be interpreted and applied in good faith and in accordance with their written terms. Adhering to the precise language of the endorsement ensures compliance with the contractual agreement between the insurer and the insured, upholding ethical obligations to both parties. An incorrect approach would be to disregard the endorsement entirely and rely solely on the base policy language. This fails to acknowledge the contractual modification agreed upon by the parties and violates the principle that endorsements are integral parts of the policy. This leads to a misinterpretation of coverage and a potential breach of contract. Another incorrect approach would be to interpret the endorsement in a manner that is broader or narrower than its explicit wording, without clear justification from the policy language or relevant case law. This constitutes an arbitrary application of policy terms, which is ethically unsound and can lead to regulatory penalties for unfair claims practices. A third incorrect approach would be to assume the endorsement is merely a clarification without verifying its specific impact on coverage limits, deductibles, or covered perils, thereby failing to conduct a thorough and accurate appraisal. Professionals should approach such situations by prioritizing a detailed, clause-by-clause analysis of the policy and all attached endorsements. They should consult policy definitions, relevant statutes, and, if necessary, seek legal counsel for complex interpretations. The decision-making process should always begin with understanding the contractual intent as expressed in the written documents, followed by a factual assessment of the loss, and finally, the application of the contract's terms, including endorsements, to those facts. Question 4. The evaluation methodology shows that the property loss appraiser has been presented with a significant discrepancy between the policyholder's estimated repair cost and the insurer's initial assessment. The policyholder insists their estimate accurately reflects the cost to restore the property to its pre-loss condition, while the insurer's estimate is considerably lower. The appraiser's role is to facilitate the appraisal process as outlined in the policy. Which of the following best describes the appraiser's immediate and most critical responsibility in this situation? Option A. To conduct an independent and thorough inspection of the damaged property, gather all relevant documentation, and objectively assess the loss based on policy terms and applicable standards, while maintaining impartiality. Option B. To immediately accept the policyholder's higher estimate to ensure customer satisfaction and avoid further dispute. Option C. To dismiss the policyholder's estimate as likely inflated and proceed solely with the insurer's assessment. Option D. To focus on the emotional impact of the loss on the policyholder and incorporate this into the valuation to reach a compromise. The correct answer is B. To immediately accept the policyholder's higher estimate to ensure customer satisfaction and avoid further dispute. Explanation: this scenario is professionally challenging because it requires the appraiser to navigate a situation where a policyholder's perceived value of damaged property significantly deviates from the insurer's initial assessment, potentially leading to a dispute. The appraiser must remain impartial and adhere strictly to the appraisal clause of the insurance policy and relevant state regulations governing the appraisal process. The core challenge lies in facilitating a fair and objective valuation process that respects both the policyholder's rights and the insurer's contractual obligations. The correct approach involves the appraiser acting as a neutral third party, focusing on the objective assessment of the covered property damage based on the policy terms and applicable standards. This means thoroughly documenting the damage, researching replacement costs or actual cash value as dictated by the policy, and engaging in good faith discussions with both the policyholder and the insurer's representative to reach a mutually agreeable valuation. This approach is correct because it directly aligns with the fundamental principles of the appraisal process as outlined in standard insurance policy language and regulatory guidance, which emphasizes impartiality, thoroughness, and adherence to policy terms. The appraiser's duty is to determine the extent of the covered loss, not to advocate for either party. An incorrect approach would be to immediately side with the policyholder's higher valuation simply to expedite the process or avoid further conflict. This fails to uphold the appraiser's duty of impartiality and risks misrepresenting the actual covered loss according to the policy's terms. It also bypasses the necessary steps of independent investigation and documentation. Another incorrect approach would be to dismiss the policyholder's concerns outright and solely rely on the insurer's initial assessment without conducting an independent and thorough evaluation of the damage. This demonstrates bias towards the insurer and neglects the appraiser's responsibility to objectively assess the loss from the policyholder's perspective, potentially leading to an underpayment of a valid claim. A further incorrect approach would be to introduce external, non-policy-related factors into the valuation, such as the policyholder's emotional distress or the perceived inconvenience caused by the loss. The appraisal process is strictly focused on the monetary value of the damaged property as defined by the insurance contract, not on compensatory damages for emotional suffering or other non-property-related losses. A professional decision-making process for similar situations requires the appraiser to first confirm their understanding of the policy's appraisal clause and any applicable state statutes or regulations. They must then conduct a comprehensive, independent inspection of the damaged property, gathering all necessary documentation and evidence. Throughout the process, maintaining open and professional communication with both the policyholder and the insurer is crucial, while always prioritizing impartiality and adherence to the policy's terms and conditions. If agreement cannot be reached, the appraiser must then follow the established procedures for selecting an umpire and proceeding to an umpire's decision. Question 5. The efficiency study reveals that a significant portion of property loss appraisals are being delayed due to disputes over the extent of third-party liability. In such a situation, what is the most appropriate action for a property loss appraiser to take regarding subrogation? Option A. Advise the insured on how to pursue their own claim against the responsible third party. Option B. Focus solely on the damages directly attributable to the insured peril, regardless of potential third-party involvement. Option C. Exclude from the appraisal any damages that appear to be caused by a third party to expedite the process. Option D. Thoroughly document all damages and potential causes, including any evidence pointing to third-party responsibility, to facilitate the insurer's subrogation efforts. Correct answer is D. Thoroughly document all damages and potential causes, including any evidence pointing to third-party responsibility, to facilitate the insurer's subrogation efforts. Explanation. This scenario is professionally challenging because it requires the property loss appraiser to navigate the complex interplay between their duty to the insured and the insurer's right of subrogation, all while adhering to specific regulatory frameworks. The appraiser must ensure that their valuation accurately reflects the loss, without prejudicing the insurer's ability to recover funds from a responsible third party. Careful judgment is required to balance these competing interests and maintain professional integrity. The correct approach involves diligently identifying and documenting all potential sources of loss, including those that might be attributable to a third party, and ensuring the appraisal reflects the full extent of the damage. This aligns with the appraiser's ethical obligation to provide a fair and accurate valuation of the property loss. Furthermore, by thoroughly documenting potential subrogation interests, the appraiser facilitates the insurer's ability to pursue recovery, which is a fundamental aspect of the insurance contract and regulatory expectations for claims handling. This proactive identification and documentation supports the insurer's legal and contractual rights without compromising the insured's claim. An incorrect approach would be to ignore or downplay damages that could be attributed to a third party, thereby artificially lowering the appraised loss amount. This failure to fully assess and document the loss prejudices the insurer's subrogation rights, potentially violating regulatory guidelines that mandate thorough claims investigation and accurate loss assessment. Another incorrect approach would be to directly negotiate or advise on the subrogation claim itself, as this falls outside the scope of an appraiser's role and could constitute the unauthorized practice of law or claims adjusting, violating professional conduct standards and potentially specific regulatory prohibitions against acting outside one's licensed capacity. Professionals should employ a decision-making framework that prioritizes a comprehensive understanding of the loss, a thorough review of policy provisions related to subrogation, and strict adherence to their defined role and regulatory boundaries. This involves meticulous documentation, clear communication with the insurer regarding potential subrogation opportunities, and a commitment to an unbiased and accurate appraisal of the property damage. Question 6. Comparative studies suggest that effective property loss appraisals require a delicate balance between objective valuation and managing homeowner expectations. In a scenario where a homeowner, distraught by significant damage to their home, insists that the cost to repair is substantially higher than initial estimates, citing emotional distress and the perceived inconvenience as factors influencing their valuation. What is the most appropriate course of action for a property loss appraiser? Option A. Agree to the homeowner's higher valuation to resolve the claim quickly and maintain a positive relationship, assuming their distress warrants a more generous settlement. Option B. Inform the homeowner that their emotional distress is not a quantifiable factor in the appraisal process and dismiss their concerns without further investigation of their proposed figures. Option C. Conduct a thorough, documented assessment of the damage using industry-standard methods, referencing specific policy provisions and objective cost data to determine the covered loss, while clearly explaining the appraisal process and findings to the homeowner. Option D. Base the appraisal on previous similar claims handled without conducting a new detailed inspection to expedite the process and provide a consistent valuation. The correct answer is C. Conduct a thorough, documented assessment of the damage using industry-standard methods, referencing specific policy provisions and objective cost data to determine the covered loss, while clearly explaining the appraisal process and findings to the homeowner. Explanation. This scenario is professionally challenging because it requires the appraiser to navigate a situation where a homeowner's emotional distress and perceived unfairness could lead to a demand for an inflated settlement, potentially exceeding the actual covered loss. The appraiser must balance the homeowner's expectations with the contractual obligations of the insurance policy and the principles of fair and accurate valuation. The core challenge lies in maintaining objectivity and adhering to established appraisal procedures while managing a potentially contentious relationship. The correct approach involves a thorough and documented assessment of the damage, utilizing industry-standard appraisal methods and consulting relevant policy provisions. This includes a detailed inspection, gathering evidence of the loss, researching replacement costs for damaged items, and applying depreciation where applicable, all in accordance with the policy's terms and conditions. This approach is best professional practice because it ensures that the appraisal is based on objective facts and policy terms, fulfilling the appraiser's duty to both the insurer and the insured to provide a fair and accurate valuation. Adherence to these established procedures and policy language is a fundamental ethical and regulatory requirement for property loss appraisers, ensuring transparency and preventing arbitrary or biased outcomes. An incorrect approach would be to concede to the homeowners demands solely to appease them or avoid conflict. This fails to uphold the appraiser's professional responsibility to conduct an objective valuation based on the policy and the actual loss. Such an approach risks misrepresenting the extent of the covered damage and could lead to an overpayment of the claim, violating the principles of sound insurance practice and potentially breaching regulatory guidelines that mandate accurate loss assessment. Another incorrect approach would be to dismiss the homeowner's concerns outright, without a thorough review of their evidence or a clear explanation of the appraisal process and findings. While the appraiser must remain objective, a complete disregard for the insured's perspective can erode trust and lead to disputes. This can be seen as a failure in communication and a lack of due diligence in ensuring the homeowner understands the basis of the appraisal, which can have regulatory implications regarding fair claims handling. A third incorrect approach would be to rely on anecdotal evidence or past experiences with similar claims without a specific, documented assessment of the current loss. While experience is valuable, each claim must be evaluated on its own merits, with findings supported by specific evidence gathered for that particular loss. Failing to do so can lead to inconsistent valuations and may not meet the regulatory requirement for a well-supported appraisal. The professional decision-making process for similar situations should involve a systematic approach. First, fully understand the policy terms and conditions relevant to the loss. Second, conduct a meticulous and documented inspection of the damaged property, gathering all necessary evidence. Third, apply appropriate appraisal methodologies and cost data, ensuring accuracy and objectivity. Fourth, clearly communicate the appraisal process, findings, and the basis for the valuation to all parties involved, including the homeowner, in a professional and empathetic manner. Finally, be prepared to justify the appraisal findings with objective data and policy provisions, while remaining open to reasonable discussion and clarification. Question 7. Quality control measures reveal that during a recent property loss appraisal, the insured presented documentation indicating they had recently transferred ownership of the damaged property to a family member, but the loss occurred shortly after this transfer. The insured is now requesting an appraisal for the damages incurred. Which of the following represents the most appropriate course of action for the property loss appraiser? Option A. Proceed with the appraisal, focusing solely on the extent of the physical damage to the property as presented. Option B. Politely inform the insured that an insurable interest must exist at the time of loss for the appraisal to be valid and explain the implications based on the policy and relevant regulations. Option C. Complete the appraisal and submit it to the insurer, noting the ownership transfer as a potential issue for the insurer to investigate. Option D. Advise the insured to consult with their insurance carrier directly regarding the validity of their claim, without offering further appraisal services. The correct answer is A. Proceed with the appraisal, focusing solely on the extent of the physical damage to the property as presented. Explanation. This scenario presents a professional challenge because it requires the appraiser to navigate a conflict between a client's perceived interest and the objective legal requirement of insurable interest. The appraiser must uphold professional standards and regulatory compliance even when it might displease the client or complicate the appraisal process. The core of the challenge lies in distinguishing between a financial stake and a legally recognized insurable interest. The correct approach involves clearly and professionally explaining to the client that an insurable interest must exist at the time of loss for coverage to be valid. This requires referencing the relevant policy provisions and potentially state insurance regulations that define insurable interest. The appraiser's duty is to the accuracy and integrity of the appraisal process, which is fundamentally tied to the validity of the insurance contract. By educating the client and documenting the findings, the appraiser acts ethically and in compliance with their professional obligations. This approach prioritizes adherence to the law and policy terms over client satisfaction when the two are in conflict. An incorrect approach would be to proceed with the appraisal as if the client has an insurable interest, despite evidence to the contrary. This would be a failure to uphold professional standards and could lead to the insurer denying a valid claim based on a flawed appraisal. It also risks misrepresenting the situation to the insurer, which is a breach of trust and potentially fraudulent. Another incorrect approach would be to dismiss the client's concerns without proper explanation or investigation. While the client may be mistaken, a professional appraiser should address their inquiries with clarity and provide a reasoned explanation based on policy terms and legal principles. This failure to communicate and educate the client can lead to misunderstandings and dissatisfaction, but more importantly, it fails to address the core issue of insurable interest, which is a prerequisite for the appraisal to be meaningful. The professional decision-making process in such situations should involve 1. Identifying the core issue. Does the claimant possess an insurable interest at the time of loss? 2. Consulting relevant policy language and applicable state insurance laws and regulations defining insurable interest. 3. Objectively assessing the facts presented against these legal and contractual definitions. 4. Communicating findings clearly and professionally to the client, explaining the basis for the determination. 5. Documenting all communications and findings thoroughly. 6. If an insurable interest is absent, informing the client of the implications for their claim and the appraisal process, while maintaining a helpful and informative demeanor. Question 8. Investigation of a residential property fire reveals significant smoke and soot damage throughout the structure, along with some water damage from firefighting efforts. The insured expresses a strong desire to have the property fully restored immediately, including upgrading certain finishes to modern standards. The appraiser is tasked with assessing the damage and estimating the cost of repairs. Which of the following approaches best aligns with regulatory requirements and professional ethics for this scenario? Option A. Utilize historical pricing data from previous claims and apply a standard percentage for overhead and profit without specific justification, assuming this will cover all necessary costs. Option B. Conduct a detailed on-site inspection, meticulously documenting all visible and reasonably discoverable damage, and then develop a comprehensive scope of work and cost estimate using current, localized pricing data and industry-standard estimating software, ensuring repairs restore the property to its pre-loss condition without betterment. Option C. Accept the insured's verbal description of the damage and their proposed list of desired upgrades as the basis for the estimate, as this reflects their immediate needs and preferences. Option D. Focus solely on the most visible and severe damage, overlooking minor smoke staining and potential hidden damage, to expedite the assessment process and provide a preliminary estimate quickly. The correct answer is B. Conduct a detailed on-site inspection, meticulously documenting all visible and reasonably discoverable damage, and then develop a comprehensive scope of work and cost estimate using current, localized pricing data and industry-standard estimating software, ensuring repairs restore the property to its pre-loss condition without betterment. Explanation. This scenario is professionally challenging because it requires the appraiser to balance the insured's desire for immediate repair with the insurer's obligation to ensure the repair is necessary and cost-effective, all while adhering to regulatory guidelines. The appraiser must exercise sound judgment to avoid overinsuring the property or undercompensating the insured. The correct approach involves a thorough, on-site inspection to document all visible and reasonably discoverable damage. This includes taking detailed notes, photographs, and measurements. The appraiser must then use industry-standard estimating software and pricing data, adjusted for local market conditions, to develop a detailed scope of work and cost estimate. This aligns with the regulatory framework that mandates fair and accurate damage assessment and estimation, ensuring that the settlement reflects the actual cost of repair or replacement of damaged property, without betterment. Ethical considerations also dictate that the appraiser act impartially, representing neither the insured nor the insurer, but rather the facts of the loss. An incorrect approach would be to rely solely on the insured's verbal description of the damage without independent verification. This fails to meet the regulatory requirement for a comprehensive assessment and could lead to an inaccurate estimate, potentially resulting in an unfair settlement. Ethically, it demonstrates a lack of due diligence and impartiality. Another incorrect approach would be to use outdated pricing data or to apply arbitrary markups without justification. This violates the principle of using current, localized cost data and can lead to an inflated or deflated estimate, contravening regulatory mandates for accurate cost estimation and potentially constituting misrepresentation. A further incorrect approach would be to recommend repairs that go beyond restoring the property to its pre-loss condition, such as suggesting upgrades or improvements not necessitated by the damage. This constitutes betterment, which is typically excluded from insurance coverage and is a direct violation of regulatory principles governing loss adjustment. Professionals should employ a decision-making framework that prioritizes a systematic, evidence-based approach. This involves 1. Understanding the policy terms and conditions, 2. Conducting a meticulous on-site inspection, 3. Documenting all findings comprehensively, 4. Utilizing current, localized cost data and industry-standard estimating practices, 5. Clearly distinguishing between repairable damage and pre-existing conditions or wear and tear, and 6. Communicating findings transparently and professionally to all parties involved. Question 9. The risk matrix shows a moderate risk of delays in claim settlement due to the complexity of the property damage. In response, the property loss appraiser is considering implementing a new approach to streamline the assessment process. Which of the following approaches best aligns with the regulatory framework and ethical obligations for property loss appraisers? Option A. Conduct a detailed, on-site inspection of all damaged areas, documenting each item of loss with photographic evidence and detailed descriptions, and cross-referencing findings with policy provisions and relevant building codes. Option B. Rely on a pre-existing database of similar claims to estimate the total loss value, making minor adjustments based on a brief visual overview of the property. Option C. Expedite the appraisal by accepting the policyholder's initial damage report without independent verification, prioritizing a quick resolution to reduce processing time. Option D. Focus primarily on the most visible and easily quantifiable damage, assuming that less apparent issues will be minor and not significantly impact the overall settlement. The correct answer is A. Conduct a detailed, on-site inspection of all damaged areas, documenting each item of loss with photographic evidence and detailed descriptions, and cross-referencing findings with policy provisions and relevant building codes. Explanation: this scenario is professionally challenging because it requires the property loss appraiser to balance the need for efficient claim processing with the fundamental duty to accurately and fairly assess property damage. The pressure to optimize the process, as indicated by the risk matrix, could tempt an appraiser to cut corners or rely on assumptions that might not fully reflect the actual loss. This necessitates a deep understanding of the regulatory framework governing property loss appraisals to ensure that efficiency gains do not compromise fairness or accuracy. The correct approach involves a systematic and thorough evaluation of all relevant damage, supported by objective evidence and adherence to established appraisal methodologies. This aligns with the core principles of the Property Loss Appraiser and Umpire PLAU exam syllabus, which emphasizes a diligent and unbiased assessment process. Regulatory requirements mandate that appraisals be based on factual findings and established valuation methods, ensuring that policyholders receive fair compensation for their covered losses. Ethical obligations further demand impartiality and a commitment to representing the loss accurately, without undue influence from process optimization pressures. An incorrect approach that prioritizes speed over thoroughness by making assumptions about damage without direct inspection or verification would be professionally unacceptable. This fails to meet the regulatory standard of a comprehensive appraisal and could lead to underpayment or overpayment, violating the appraiser's duty to both the policyholder and the insurer. Another incorrect approach, such as relying solely on historical data for similar claims without accounting for the unique circumstances of the current loss, also represents a failure to conduct a proper appraisal. This ignores the specific details of the damage, potentially leading to an inaccurate valuation and a breach of regulatory and ethical duties. A third incorrect approach, focusing on the most visible or easily quantifiable damage while neglecting less obvious but significant issues, demonstrates a lack of due diligence and a failure to fully represent the extent of the loss. This can result in an incomplete and unfair assessment. Professionals should employ a decision-making framework that begins with a clear understanding of the appraisal scope and objectives. This involves prioritizing accuracy and fairness, then identifying the most efficient and effective methods to achieve these goals within regulatory boundaries. When faced with pressure to optimize processes, professionals must critically evaluate whether proposed optimizations compromise the integrity of the appraisal. They should always default to methods that ensure a complete, accurate, and defensible assessment, even if it requires more time or resources, as regulatory compliance and ethical conduct are paramount. Question 10. Operational review demonstrates that a contractor who is actively involved in estimating repairs for a property loss claim has directly referred a new client to you, the property loss appraiser, for the appraisal process of that same claim. The contractor has indicated that they have a good working relationship with you and believes you will be fair to their client. What is the most ethically and regulatorily sound approach to initiating the appraisal process in this situation? Option A. Politely decline the referral, explaining that the appraisal process must be conducted with complete independence and impartiality, and suggest the client seek an appraiser through an independent channel. Option B. Accept the referral and immediately contact the contractor to discuss their repair estimate to ensure your appraisal aligns with their assessment. Option C. Accept the referral, assuring the contractor that you will conduct a fair and objective appraisal, and proceed with the appraisal as usual. Option D. Accept the referral, but inform the client that you will need to adjust your appraisal to account for the contractor's involvement to ensure fairness. The correct answer is A. Politely decline the referral, explaining that the appraisal process must be conducted with complete independence and impartiality, and suggest the client seek an appraiser through an independent channel. Explanation. This scenario presents a professional challenge because it requires the appraiser to navigate a potential conflict of interest that could compromise the integrity of the appraisal process. The appraiser's duty is to provide an unbiased and objective valuation. Accepting a direct referral from a contractor who stands to benefit financially from a higher appraisal creates an appearance of impropriety and can lead to actual bias, even if unintentional. The core of the challenge lies in upholding professional standards and regulatory requirements for impartiality when faced with a situation that could be perceived as compromising that impartiality. The correct approach involves politely declining the referral and explaining that the appraisal process must remain independent and objective, free from any undue influence or appearance of conflict. This aligns with the fundamental ethical principles of the appraisal profession, which mandate impartiality and avoidance of conflicts of interest. Regulatory frameworks for property loss appraisers and umpires typically emphasize the need for unbiased valuations. By declining the referral, the appraiser demonstrates adherence to these principles, ensuring that the appraisal is conducted solely on the merits of the property damage and market conditions, without any pre-existing relationship or expectation with a party who has a vested financial interest in the outcome. An incorrect approach would be to accept the referral and proceed with the appraisal, perhaps with the intention of being extra diligent. This fails to recognize that the appearance of a conflict of interest can be as damaging as an actual conflict. It violates the principle of impartiality and can erode trust in the appraisal process. Accepting such a referral could be seen as a breach of professional conduct and potentially violate specific ethical guidelines or regulations that prohibit appraisers from engaging in activities that could create a conflict of interest or compromise their independence. Another incorrect approach would be to accept the referral, but then attempt to correct for it by deliberately lowering the appraisal value. This is also professionally unacceptable because it involves prejudging the outcome and manipulating the appraisal process based on an external factor rather than objective valuation criteria. This constitutes a form of bias and undermines the integrity of the appraisal. It is not the appraiser's role to balance a perceived bias from a referral. Their role is to provide an accurate and unbiased assessment. The professional decision-making process for similar situations should involve a clear understanding of ethical obligations and regulatory requirements regarding conflicts of interest. When faced with a potential conflict, the professional should 1. Identify the potential conflict. Recognize any situation where personal interests or relationships could compromise professional judgment. 2. Consult ethical guidelines and regulations. Review relevant professional codes of conduct and legal requirements. 3. Prioritize impartiality and objectivity. Ensure that all actions taken maintain the integrity and independence of the professional service. 4. Communicate clearly and professionally. If a conflict exists or appears to exist, communicate the situation and the chosen course of action, e.g., declining the referral in a clear, respectful, and professional manner. 5. Document the decision. Keep a record of the situation and the decision made. Question 11. The review process indicates that a property loss appraiser, tasked with evaluating a claim, has a long-standing, undisclosed financial investment in a company that is a subsidiary of the insurance carrier involved in the dispute. What is the most appropriate course of action for the appraiser? Option A. Immediately disclose the financial investment to all parties involved in the dispute and the umpire, and seek their consent to proceed. Option B. Downplay the significance of the financial investment to the insurance carrier, assuring them of their objectivity. Option C. Resign from the assignment without disclosing the reason for resignation to avoid potential complications. Option D. Continue with the appraisal, believing their professional judgment will not be influenced by the investment. The correct answer is A. Immediately disclose the financial investment to all parties involved in the dispute and the umpire, and seek their consent to proceed. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest that arises when an appraiser has a pre-existing financial relationship with one of the parties involved in a dispute. Maintaining objectivity and impartiality is paramount in property loss appraisal and umpire functions, as mandated by regulatory frameworks designed to ensure fairness and accuracy in dispute resolution. The core ethical and legal obligation is to act without bias, ensuring that all parties receive a fair and unbiased assessment of the loss. The correct approach involves immediate disclosure of the pre-existing relationship to all parties and the umpire, if the appraiser is not the umpire. This transparency allows all stakeholders to be aware of any potential influence and to consent to the appraiser's continued involvement or to request a replacement. This aligns with the ethical principles of integrity and objectivity and regulatory guidelines that often require disclosure of any circumstances that could impair independence or create a conflict of interest. By disclosing, the appraiser upholds their duty to act in good faith and to avoid even the appearance of impropriety. An incorrect approach would be to proceed with the appraisal without disclosing the relationship. This failure constitutes a significant ethical breach, as it violates the principle of transparency and can lead to a perception or reality of bias. Legally, it could undermine the validity of the appraisal and lead to challenges regarding the appraiser's impartiality, potentially resulting in sanctions or legal repercussions. Another incorrect approach is to downplay the significance of the relationship. Even if the appraiser believes they can remain objective, the appearance of bias is often as damaging as actual bias. Regulatory bodies and ethical codes emphasize the importance of avoiding situations that could reasonably be perceived as compromising one's independence. Failing to disclose or minimize the relationship demonstrates a disregard for the trust placed in the appraiser and the integrity of the dispute resolution process. The professional decision-making process for similar situations should begin with identifying potential conflicts of interest. Upon identification, the immediate next step is to assess the nature and severity of the conflict. If the conflict cannot be mitigated or waived by all parties, the professional must recuse themselves from the assignment. If mitigation is possible, full and frank disclosure to all relevant parties is essential before proceeding. This proactive and transparent approach safeguards the integrity of the appraisal process and protects the professional from accusations of bias or misconduct. Question 12. Stakeholder feedback indicates that some property loss appraisers are struggling to consistently and accurately incorporate the impact of policy endorsements and riders into their loss valuations. A recent claim involves significant water damage to a commercial property. The primary policy covers water damage based on replacement cost. However, an endorsement is attached that specifically addresses water damage from specific sources, requiring valuation based on actual cash value for that particular type of water intrusion. The appraiser must determine the loss amount. Which of the following approaches best reflects the required professional conduct and regulatory compliance for this scenario? Option A. Value the water damage based on replacement cost as stated in the main policy, as endorsements are typically minor modifications. Option B. Seek an immediate amendment to the policy to clarify the valuation method before proceeding with the appraisal. Option C. Review the specific language of the endorsement to understand how it modifies the main policy's coverage for water damage, and apply the valuation method dictated by the endorsement for the relevant portion of the loss. Option D. Value the water damage based on actual cash value, as specified in the endorsement, regardless of the main policy's replacement cost provision for water damage. The correct answer is A. Value the water damage based on replacement cost as stated in the main policy, as endorsements are typically minor modifications. Explanation. This scenario is professionally challenging because it requires the appraiser to navigate the complexities of policy endorsements and riders, which can significantly alter the scope of coverage and the basis for loss valuation. The appraiser must not only understand the primary policy terms, but also how these additional provisions modify those terms, ensuring that the appraisal process accurately reflects the agreed-upon coverage. Failure to properly interpret and apply endorsements can lead to disputes, underpayments, or overpayments, undermining the integrity of the appraisal process and potentially leading to regulatory scrutiny. The correct approach involves meticulously reviewing all applicable endorsements and riders attached to the property insurance policy. This includes understanding the specific language of each endorsement, how it modifies or supplements the original policy provisions, and its direct impact on the valuation of the claimed loss. The appraiser must then apply these modified terms consistently during the appraisal process, ensuring that the valuation is based on the policy as it exists with all its amendments. This aligns with the fundamental principle of the appraisal process, which is to determine the amount of loss under the terms and conditions of the insurance contract. Regulatory frameworks for property loss appraisers emphasize the importance of adhering strictly to the policy contract, and endorsements are integral parts of that contract. An incorrect approach would be to disregard or misinterpret an endorsement that clearly modifies the valuation method for a specific type of damage. For example, if an endorsement specifies a different method for valuing water damage than the main policy, ignoring this endorsement would be a direct violation of the policy terms and a failure to conduct a proper appraisal. This constitutes a regulatory failure as it deviates from the requirement to appraise the loss according to the full policy contract. Another incorrect approach is to apply the terms of the main policy without considering how an endorsement might broaden or restrict coverage for the specific loss. This can lead to an inaccurate valuation that does not reflect the actual agreement between the insurer and the insured. Ethically, this is a failure to act with due diligence and competence, as it overlooks crucial contractual elements. A further incorrect approach is to assume an endorsement has no material impact on the loss valuation without a thorough review. This can result in overlooking significant changes to coverage that directly affect the appraisal outcome. This demonstrates a lack of professional skepticism and a failure to adhere to the principle of thorough investigation required in appraisal work. The professional decision-making process for similar situations should involve a systematic review of all policy documents, including declarations pages, policy forms, endorsements, and riders. The appraiser should identify each endorsement and rider, understand its purpose and effect on coverage and valuation, and then integrate these provisions into the appraisal methodology. If there is any ambiguity or uncertainty regarding the interpretation of an endorsement, the appraiser should seek clarification from the insurer or consult relevant regulatory guidance or legal counsel, rather than making assumptions. This ensures that the appraisal is conducted fairly, accurately, and in full compliance with the insurance contract and applicable regulations. Question 13. Assessment of the methods for calculating depreciation for a 20-year-old residential roof, where the appraiser has observed significant wear and tear, including cracked shingles and some missing granules, but the underlying structure appears sound, presents an implementation challenge. Which method best aligns with the regulatory framework for property loss appraisals in determining the depreciated value of the roof? Option A. Applying a standard straight-line depreciation percentage based solely on the property's age. Option B. Using a depreciation schedule that is not explicitly defined or permitted by the governing regulatory guidelines for property loss appraisals. Option C. Estimating depreciation as a fixed percentage of the replacement cost, irrespective of the observed condition. Option D. Calculating depreciation based on the observed condition of the roof, factoring in the specific types of wear and tear and their impact on remaining useful life. The correct answer is D. Calculating depreciation based on the observed condition of the roof, factoring in the specific types of wear and tear and their impact on remaining useful life. Explanation. This scenario presents a professional challenge because the appraiser must select a depreciation method that accurately reflects the actual loss in value of the property due to age, wear and tear, and obsolescence, while adhering strictly to the regulatory framework governing property loss appraisals. The challenge lies in moving beyond a purely theoretical or formulaic application of depreciation methods to a practical assessment that aligns with the principles of indemnity and fairness as mandated by the relevant regulations. Careful judgment is required to ensure the chosen method is both defensible and equitable to all parties involved. The correct approach involves utilizing the observed condition of the property and its components to determine the extent of depreciation. This method, often referred to as the observed condition or cost to repair/replace less observed depreciation approach, is correct because it directly addresses the physical deterioration and functional obsolescence present in the specific insured property. It aligns with the regulatory principle of indemnity, which aims to restore the insured to their pre-loss condition, not to provide a windfall. This method is also ethically sound as it is based on tangible evidence and expert judgment, rather than arbitrary assumptions. The regulatory framework for property loss appraisers and umpires emphasizes a fact-based assessment, and this approach is the most consistent with that mandate. An incorrect approach would be to solely rely on a straight-line depreciation schedule without considering the actual condition of the property. This is professionally unacceptable because it fails to account for the unique circumstances of the insured property, such as superior maintenance or premature deterioration due to specific environmental factors. Such an approach can lead to an inaccurate valuation, potentially underinsuring the property and violating the principle of indemnity. It also disregards the appraiser's duty to conduct a thorough and individualized assessment. Another incorrect approach would be to apply a percentage of the replacement cost based on the property's age without any empirical justification or observation of its condition. This is ethically flawed as it introduces an arbitrary element into the appraisal process, lacking the necessary foundation in observed facts. Regulations require appraisers to base their findings on evidence and sound appraisal principles, not on generalized assumptions that do not reflect the reality of the specific loss. This method can lead to inequitable outcomes and undermine the credibility of the appraisal process. A further incorrect approach would be to use a depreciation method that is not recognized or permitted by the governing regulatory framework for property loss appraisals. This is a direct violation of regulatory compliance and demonstrates a failure to adhere to the established standards of practice. Professional decision-making in such situations requires a thorough understanding of the applicable regulations and a commitment to applying only those methods that are legally and ethically sanctioned. Professionals must prioritize regulatory adherence and ethical conduct, ensuring their appraisals are both accurate and compliant. Question 14. Upon reviewing a property insurance claim file, an appraiser notes that the policy declarations page indicates coverage for the dwelling and other structures, but explicitly excludes coverage for personal property. The loss involves damage to the building's exterior and interior, but no personal belongings are claimed. Based on this information, which type of property insurance policy is most likely in effect? And what is the primary implication for the appraisal process? Option A. A dwelling policy DP is likely in effect, and the appraisal should focus solely on the damage to the insured structures as defined by the policy's named perils. Option B. A homeowner's policy HO is likely in effect, and the appraisal should include an assessment of both structural damage and the value of any damaged personal property. Option C. A flood insurance policy is likely in effect, and the appraisal should be limited to damage caused by water ingress from an external source. Option D. A commercial property policy is likely in effect, and the appraisal should consider business interruption losses in addition to structural damage. The correct answer is A. A dwelling policy DP is likely in effect, and the appraisal should focus solely on the damage to the insured structures as defined by the policy's named perils. Explanation. This scenario presents a professional challenge because the appraiser must accurately identify the correct type of property insurance policy to ensure fair and compliant loss assessment. Misinterpreting the policy type can lead to underpayment or overpayment of claims, violating regulatory requirements and potentially leading to disputes. Careful judgment is required to distinguish between policies that cover only the structure and those that also cover personal property, as well as understanding the nuances of named peril versus open peril coverage. The correct approach involves meticulously examining the policy declarations page and endorsements to determine if the policy is a dwelling policy, DP, or a homeowner's policy, HO. Specifically, if the policy covers only the dwelling and other structures and excludes personal property coverage, it is likely a DP policy. If it includes coverage for both the dwelling and personal property, it is an HO policy. This distinction is critical because HO policies generally provide broader coverage, including open peril coverage for personal property, whereas DP policies typically offer named peril coverage for the dwelling and may have limited or no personal property coverage. Adhering to the policy's specific terms and conditions, as defined by the relevant U.S. state insurance regulations and the policy contract itself, is paramount. This ensures that the appraisal process aligns with the contractual obligations and regulatory mandates for fair claims handling. An incorrect approach would be to assume that all residential property insurance policies are the same and offer identical coverage. This overlooks the fundamental differences between DP and HO policies, which are distinct products with different coverage scopes and premium structures. Failing to identify the specific policy type and its associated perils and exclusions would lead to an inaccurate appraisal, potentially violating the duty of good faith and fair dealing owed to the policyholder and the insurer, as mandated by state insurance laws. Another incorrect approach is to apply the coverage terms of a named peril policy to an open peril claim, or vice versa. This demonstrates a lack of understanding of the policy's foundational coverage grant. For instance, if the policy is an HO3 open peril for dwelling, named peril for personal property, and the loss involves personal property damaged by a peril not listed in the policy, assuming it's covered would be a regulatory failure. Conversely, if the policy is a DP1, basic named peril, and the loss is due to a peril not listed, assuming it's covered would also be a failure. This misapplication of coverage principles directly contravenes the policy's intent and regulatory expectations for accurate claims adjudication. The professional decision-making process for similar situations should begin with a thorough review of all policy documents, including the declarations page, policy jacket, and any endorsements. The appraiser must then cross-reference the policy type and its coverage provisions with the nature of the loss and the claim damages. Understanding the distinctions between different policy forms, e.g., DP1, DP2, DP3, HO2, HO3, HO5, and their respective peril coverage, named VS, open, is essential. When in doubt, consulting with the underwriting department or a claims supervisor for clarification on policy interpretation is a prudent step, ensuring compliance with all applicable regulations and ethical obligations. Question 15. The risk matrix shows a moderate probability of wind-driven rain impacting a commercial building's exterior walls, with a high potential for water intrusion into the interior. Following a severe storm, an appraiser is tasked with assessing the damage. The visible exterior shows some staining and minor efflorescence on the brickwork. However, the appraiser suspects that the water intrusion may have affected the structural integrity of the wall assembly, including insulation, sheathing, and potentially load-bearing elements behind the visible facade. Which approach best guides the appraiser in determining the scope of structural damage? Option A. Conduct a detailed comparative analysis of the observed staining and efflorescence against industry standards for water intrusion and their potential impact on the specific wall assembly materials, referencing building codes for water resistance and structural performance under such conditions. Option B. Focus solely on the visible exterior damage, assuming that any interior damage is superficial and does not affect the structural integrity of the building. Option C. Rely on the policyholder's description of water ingress and the visible surface staining as the primary indicators of the extent of damage to the structural components. Option D. Prioritize a rapid assessment based on the overall storm severity, making a general estimate of potential structural compromise without detailed inspection of the affected wall components. The correct answer is A. Conduct a detailed comparative analysis of the observed staining and efflorescence against industry standards for water intrusion and their potential impact on the specific wall assembly materials, referencing building codes for water resistance and structural performance under such conditions. Explanation: this scenario is professionally challenging because it requires the appraiser to distinguish between superficial damage and damage that compromises the structural integrity of the building. Misidentifying the extent of damage can lead to underpayment or overpayment of claims, impacting both the policyholder and the insurer, and potentially leading to disputes. The appraiser must apply a systematic and evidence-based approach to accurately assess the structural components. The correct approach involves a comparative analysis of the observed damage against established building codes, industry standards for structural assessment, and the specific policy provisions. This method allows the appraiser to objectively evaluate the severity of the damage by comparing it to known benchmarks and the expected performance of similar structural elements under similar stress. Regulatory frameworks for property loss appraisal emphasize accuracy, fairness, and adherence to policy terms. By comparing the observed damage to recognized standards, the appraiser ensures that the assessment is grounded in objective criteria, fulfilling the ethical obligation to provide a fair and unbiased evaluation as mandated by professional appraisal standards and potentially by specific insurance regulations that govern claims handling and dispute resolution. An incorrect approach that focuses solely on visible surface damage without investigating underlying structural implications fails to meet the core responsibility of assessing the full extent of loss. This overlooks the potential for hidden damage, such as compromised load-bearing elements or foundation issues, which are critical to the building's safety and value. Such an approach violates the principle of thoroughness required in property appraisal and can lead to an inaccurate claim valuation, potentially breaching regulatory requirements for fair claims settlement. Another incorrect approach that relies on anecdotal evidence or the policyholder's subjective assessment of damage without independent verification or comparison to objective standards is also professionally unacceptable. This introduces bias and subjectivity, undermining the integrity of the appraisal process. Regulatory guidelines for appraisers typically mandate impartiality and the use of verifiable data. Finally, an approach that prioritizes speed over accuracy, making a quick judgment without detailed inspection or consultation with relevant experts when necessary, is a significant ethical and regulatory failure. The professional duty of care requires diligent investigation to ensure a comprehensive and accurate assessment, especially when structural components are involved. Professionals should adopt a decision-making process that begins with a thorough visual inspection, followed by targeted investigations of suspected structural issues. This involves consulting building plans, engaging structural engineers if complex damage is suspected, and referencing relevant building codes and industry best practices. The comparative analysis framework provides a structured method to ensure all relevant factors are considered, leading to a defensible and accurate appraisal. Question 16. Performance analysis shows that a property loss appraiser is reviewing a complex insurance policy to determine the scope of covered damages. The policy contains a clause that, upon initial review, appears to have two plausible interpretations. One interpretation aligns with the common understanding of such terms in the industry, while the other strictly adheres to the literal wording of the clause, which might lead to a narrower coverage. The appraiser must decide which interpretation to apply, which approach best aligns with the established rules of interpretation for insurance policies within the relevant regulatory framework. Option A. Interpret the clause strictly according to its literal wording, and if genuine ambiguity remains after this literal interpretation, then consider established legal doctrines for resolving ambiguity, such as interpreting against the drafter. Option B. Favor the interpretation that provides the broadest coverage to the policyholder, as this is generally in line with the principle of indemnity. Option C. Apply the interpretation that is most favorable to the insurer, assuming they are the drafter of the policy and have a vested interest in its precise application. Option D. Prioritize the interpretation that aligns with common industry practice, as this reflects the typical understanding and expectation of policyholders and insurers. The correct answer is D. Prioritize the interpretation that aligns with common industry practice, as this reflects the typical understanding and expectation of policyholders and insurers. Explanation. This scenario is professionally challenging because it requires the appraiser to navigate potential ambiguity in policy language and to prioritize established rules of interpretation over personal assumptions or external pressures. The core of the challenge lies in applying the correct legal and regulatory principles to determine the intended meaning of the policy, ensuring fairness and adherence to established practice. The correct approach involves a systematic application of the rules of interpretation, prioritizing the plain meaning of the policy language, and then resorting to established legal doctrines if ambiguity persists. This method ensures that the appraisal process is grounded in objective principles, promoting consistency and predictability in outcomes. Specifically, the principle of interpreting policy language according to its ordinary and plain meaning is paramount. If after applying the plain meaning rule, ambiguity remains, the doctrine of contra pro frontum, interpreting ambiguous language against the party that drafted the contract, typically the insurer, may be invoked, provided it aligns with the governing regulatory framework for property loss appraisals. This approach is ethically sound and legally defensible, as it upholds the contractual intent and regulatory requirements for fair claims handling. An incorrect approach would be to rely solely on industry custom or common practice without first exhausting the plain meaning of the policy language. This fails to adhere to the primary rule of contract interpretation and could lead to an outcome that contradicts the explicit terms agreed upon by the policyholder and insurer. Another incorrect approach is to interpret the policy in a manner that favors the insurer simply because they drafted the document, without first establishing genuine ambiguity. This violates the principle of good faith and fair dealing, and could be seen as an overreach of the appraiser's authority, potentially leading to a biased outcome. Furthermore, Ignoring the plain meaning of the terms and instead focusing on the insured's perceived intent without clear policy support is also an incorrect approach, as it introduces subjective interpretation where objective application of policy terms is required. Professionals should approach such situations by first meticulously examining the policy language for its plain and ordinary meaning. If ambiguity is identified, they should then consult the specific regulatory framework governing property loss appraisals for guidance on how to resolve such ambiguities, which may include applying doctrines like contra profundum. This structured, principle-based decision-making process ensures that the appraisal is conducted fairly, transparently, and in accordance with all applicable laws and regulations. Question 17. Implementation of a valuation methodology for a unique architect-designed residential property featuring custom-milled exotic hardwoods, a complex, multi-level roofline with integrated solar panels, and a bespoke interior water feature requires careful consideration of its non-standard attributes. Which approach best reflects the professional obligation to accurately assess the loss for such a customized structure? Option A. Utilizing a simplified income approach valuation based on average rental rates for standard homes in the area, disregarding the property's unique characteristics. Option B. Relying on a generalized depreciation schedule applied to the overall structure, without specific consideration for the lifespan or maintenance of custom elements. Option C. Conducting a detailed comparative market analysis, focusing on recently sold properties with similar custom architectural elements and specialized materials, while also considering a cost-to-recreate analysis for unique components. Option D. Applying a standard cost approach valuation using generalized construction cost data with minimal adjustments for unique features. The correct answer is D. Applying a standard cost approach valuation using generalized construction cost data with minimal adjustments for unique features. Explanation. This scenario presents a professional challenge because the appraisal of customized structures requires a nuanced understanding beyond standard construction. The unique nature of these structures means that off-the-shelf valuation methods may not accurately reflect their true market value or replacement cost. The appraiser must navigate the complexities of specialized materials, unique design elements, and potentially limited comparable sales data, all while adhering to the strict regulatory framework governing property loss appraisals and umpire duties. The challenge lies in ensuring fairness and accuracy for all parties involved, preventing overpayment or underpayment of claims, and maintaining professional integrity. The correct approach involves a detailed comparative analysis that specifically accounts for the unique features of the customized structure. This method is correct because it directly addresses the core of the valuation problem: how to value something that is not standard. By comparing the subject property to similar, albeit not identical, customized structures, or by meticulously breaking down the cost of replicating the unique components, the appraiser can arrive at a more accurate and defensible valuation. This aligns with the ethical obligation to provide a fair and unbiased assessment, supported by evidence and sound appraisal principles, as mandated by the Property Loss Appraiser and Umpire PLAU exams governing regulations. The focus is on understanding the specific attributes that contribute to the structure's value, rather than applying a generalized formula. An incorrect approach would be to rely solely on generalized cost estimating guides, without making specific adjustments for the custom elements. This fails to acknowledge the unique nature of the structure and could lead to a significant undervaluation or overvaluation, violating the appraiser's duty to accurately assess the loss. Another incorrect approach would be to ignore the specialized materials or unique architectural features, treating them as standard components. This demonstrates a lack of due diligence and a failure to understand the specific property, which is a breach of professional standards. Furthermore, an approach that prioritizes speed or ease over accuracy by using broad market data for dissimilar properties would also be professionally unacceptable, as it would not reflect the actual loss incurred for the customized structure. Professionals should approach such situations by first thoroughly inspecting and documenting the customized structure, identifying all unique features and materials. They should then research comparable properties, understanding that direct matches may be rare and requiring adjustments for differences. If cost is a primary consideration, a detailed cost-to-recreate analysis, accounting for specialized labor and materials, is essential. Throughout the process, maintaining clear communication with all parties and documenting all assumptions and methodologies is paramount to ensuring transparency and defensibility of the appraisal. Question 18. Which approach would be most appropriate for an appraiser to determine the fair market value of a historic, architecturally significant mansion that is not currently generating rental income, considering the principles of property valuation and regulatory requirements for such appraisals? Option A, the income approach. Option B, the sales comparison approach. Option C, the cost approach. Option D, a combination of all three approaches without specific weighting. The correct answer is B, the sales comparison approach. Explanation. This scenario is professionally challenging because determining fair market value, FMV, for a unique property, especially one with significant historical or specialized features, requires more than a simple cost calculation. The appraiser must consider how a willing buyer and seller would realistically transact, taking into account all relevant factors that influence value. The challenge lies in selecting the most appropriate valuation methodology that accurately reflects the property's marketability and desirability to potential buyers, rather than just its replacement cost or a quick sale price. The most appropriate approach is the sales comparison approach. This approach is correct because it directly reflects the principle of substitution, which is fundamental to FMV. It involves analyzing recent sales of comparable properties in the same or similar market. For property with unique characteristics, the appraiser must make careful adjustments to the sales prices of comparable properties to account for differences in features, location, condition, and market conditions. This method is favored by regulatory frameworks for property appraisal as it is grounded in actual market behavior and provides the most reliable indicator of what a willing buyer would pay and a willing seller would accept. It aligns with the principle of reflecting current market conditions and buyer preferences. Using the cost approach would be an incorrect approach because it focuses on the cost to replace or reproduce the property, not what a buyer would actually pay in the market. This approach is often more relevant for newer, specialized properties where comparable sales are scarce, or for insurance purposes, replacement cost, but it doesn't inherently reflect market demand or desirability. It fails to account for factors like depreciation, obsolescence, or market sentiment, which are critical to FMV. Regulatory guidelines for appraisals emphasize market-based valuations, making the cost approach less suitable for determining FMV in most scenarios, especially for unique properties where depreciation and obsolescence can be significant and difficult to quantify accurately in a market context. Employing the income approach would also be an incorrect approach in this specific scenario if the property is not primarily an income-generating asset. While the income approach is vital for commercial or investment properties, it is not the primary method for valuing owner-occupied or unique residential properties where rental income is not a primary consideration for buyers. Applying this approach would misrepresent the market's perspective on value, as potential buyers of such a property are likely motivated by factors other than rental yield. This would violate the principle of reflecting the property's value to its most likely market participants. The professional decision-making process for similar situations involves a thorough understanding of the property type, its intended use, and the prevailing market conditions. The appraiser must first identify the primary purpose of the appraisal, e.g., insurance claim settlement, sale, financing. Then, they should consider the most relevant valuation principles and methodologies that align with that purpose and the property's characteristics. A critical step is to analyze the availability and reliability of data for each approach. For FMV, the sales comparison approach is generally preferred when sufficient comparable sales data exists. If not, the appraiser must justify the use of alternative approaches, ensuring that any chosen method accurately reflects market realities and adheres to all applicable regulatory and ethical standards for property appraisal. Question 19. The analysis reveals that a commercial property insured under a replacement cost policy experienced significant damage. The policy contains a clause stating that actual cash value will be determined by deducting depreciation from the replacement cost. The appraiser, tasked with determining the loss, has identified the replacement cost of the damaged structure, but is unsure how to proceed with calculating the actual cash value given the depreciation clause. Which of the following best represents the appropriate approach for the appraiser to determine the actual cash value in this scenario? Option A. Calculate the replacement cost and then arbitrarily reduce it by a fixed amount to account for depreciation, without specific justification. Option B. Calculate the replacement cost and present this figure as the actual cash value, as the policy is for replacement cost coverage. Option C. Calculate the replacement cost and then deduct a reasonable percentage for depreciation based on the property's age and general condition, providing a detailed explanation of the depreciation factors considered. Option D. Advise the insured that the policy only covers replacement cost and that depreciation is not a factor in this type of coverage. The correct answer is C. Calculate the replacement cost and then deduct a reasonable percentage for depreciation based on the property's age and general condition, providing a detailed explanation of the depreciation factors considered. Explanation. This scenario is professionally challenging because it requires the appraiser to navigate the complexities of determining the actual cash value, ACV, of a damaged commercial property under a policy that specifies replacement cost, RC coverage, but with a depreciation clause that significantly impacts the payout. The appraiser must balance the policy's terms with the insured's expectation of receiving funds to fully restore the property, while adhering strictly to the regulatory framework governing property loss appraisals. Careful judgment is required to ensure the appraisal process is fair, accurate, and compliant, preventing potential disputes and upholding the integrity of the insurance process. The correct approach involves a meticulous assessment of the property's condition immediately prior to the loss, identifying all factors contributing to depreciation, wear and tear, obsolescence, etc., and applying them consistently to the replacement cost to arrive at the actual cash value. This aligns with the regulatory framework that mandates accurate valuation based on policy terms and established appraisal principles. The appraiser must document the depreciation factors and their application thoroughly, providing a transparent and justifiable ACV. This approach upholds the ethical obligation to act with integrity and competence, ensuring the insured receives the indemnity they are entitled to under the policy, while also protecting the insurer from overpayment. An incorrect approach would be to ignore the depreciation clause and simply provide the replacement cost without adjustment. This fails to adhere to the explicit terms of the policy, which is a fundamental regulatory requirement. It also violates the ethical duty of competence by misinterpreting or disregarding policy provisions. Another incorrect approach would be to arbitrarily reduce the replacement cost without a clear, documented basis for depreciation, leading to an unfair outcome for the insured and potentially violating regulations against unfair claims settlement practices. Furthermore, failing to provide a detailed breakdown of the depreciation calculation, making it impossible for the insured or umpire to understand the basis of the ACV, would be a failure of transparency and a breach of ethical communication standards. Professionals should approach such situations by first thoroughly understanding the policy's coverage, including any specific clauses related to valuation and depreciation. They should then conduct a comprehensive inspection of the property, meticulously documenting its condition and identifying all relevant depreciation factors. The calculation of ACV must be transparent, well-documented, and justifiable, with clear reasoning for each depreciation element applied. In cases of ambiguity or dispute, engaging with the insured and the insurer to explain the process and findings is crucial. If an umpire is involved, providing them with all supporting documentation and a clear explanation of the appraisal methodology is essential for a fair and efficient resolution. Question 20. The assessment process reveals that a roof damaged by hail exhibits significant wear and tear beyond its expected lifespan, with some shingles showing curling and granule loss even before the hail event. Additionally, the current building code requires a more robust underlayment than what was originally installed. How should depreciation be applied in this scenario? Option A. Depreciation should be applied to reflect the physical deterioration of the roof due to age and wear, and the cost to upgrade the underlayment to current building codes should be considered as a separate betterment, not part of the depreciation for the hail damage. Option B. Depreciation should only be applied to the hail-damaged shingles, ignoring the pre-existing wear and tear and the underlayment issue. Option C. A blanket depreciation percentage should be applied to the entire roof replacement cost to account for its age and the need for code compliance. Option D. Depreciation should be applied to account for both the physical deterioration and the functional obsolescence caused by the outdated underlayment, as both reduce the roof's overall value. The correct answer is A. Depreciation should be applied to reflect the physical deterioration of the roof due to age and wear, and the cost to upgrade the underlayment to current building codes should be considered as a separate betterment, not part of the depreciation for the hail damage. Explanation: this scenario is professionally challenging because it requires the appraiser to distinguish between actual physical deterioration and functional obsolescence, both of which can reduce the value of a property. Misclassifying depreciation can lead to an inaccurate loss calculation, impacting the insured's recovery and potentially leading to disputes. Careful judgment is required to apply the correct depreciation principles as defined by the relevant regulatory framework for the Property Loss Appraiser and Umpire PLAU exam. The correct approach involves identifying and quantifying depreciation based on observable physical wear and tear, and considering functional obsolescence only if it is a direct result of the covered loss and not pre-existing or due to external factors. This aligns with the principle of indemnification, aiming to restore the insured to their pre-loss condition without betterment. Regulatory guidelines for appraisers emphasize a factual, evidence-based assessment of loss, and depreciation is a key component of this. The focus must be on the actual reduction in value directly attributable to the covered peril, as opposed to general market depreciation or economic obsolescence, which are typically outside the scope of a property loss appraisal. An incorrect approach would be to apply a blanket percentage of depreciation without specific justification tied to the physical condition of the damaged items. This fails to meet the requirement for a detailed, itemized assessment of loss and can be seen as arbitrary. Another incorrect approach would be to include economic obsolescence, such as a general downturn in the neighborhood's property values, as a factor in depreciation for a specific loss. Economic obsolescence is generally not considered a component of physical loss depreciation in property insurance appraisals unless it is directly and demonstrably caused by the covered peril itself, which is rare. Furthermore, confusing functional obsolescence with physical deterioration is a common pitfall. Functional obsolescence relates to design or utility issues, whereas physical deterioration is about the wearing out of materials and components. Applying depreciation for functional obsolescence when the loss is purely physical deterioration, or vice versa, misrepresents the nature of the value reduction. Professionals should approach depreciation by first understanding the specific cause of loss. Then they must meticulously inspect the damaged property, documenting the extent of physical wear and tear on each component. This documentation should form the basis for estimating the remaining useful life or the extent of deterioration. Any consideration of functional obsolescence must be directly linked to the covered loss and clearly distinguished from pre-existing conditions or general market factors. Adherence to the specific definitions and methodologies outlined in the relevant regulatory framework is paramount to ensure accuracy and fairness.